Thinking Byzantine here, and today we'll be talking about STAG Industrial. Now, for a quick disclaimer, I'm not a financial advisor. This is all my own opinion. Your investments are your own responsibility. The information that I'll be using was from January 10th or before, and I do have a stake in this company. Now, before we get into this, let's do a quick industry outlook on industrial REITs. So the impact of COVID. The biggest impact of COVID on industrial REITs was the interest rate. As interest rate has hit all-time lows, this has led to a boom in construction. Now, as for rent growth and vacancies, with an increase in construction and pricing, this has led to weakening in pricing power for industrial REITs, as they're only able to increase their rent on average 3.5% for 2020 versus 6% in 2018. Vacancies has also increased due to COVID and increased construction, with a vacancy rate on average of 5.7% compared to 5.3% in Q1. Now here are some quick stats and fun facts about STAG. So we have a previous close of $30.25, 52-week high of $34.50, 52-week low of $17.54, a market cap of about $4.8 billion, and STAG currently pays a dividend of $1.44. STAG was founded in 2010. STAG is an industrial REIT, and it's a monthly dividend payer. Now, what do they do? STAG Industrial is a real estate investment trust, or REIT, focused on the acquisition and operations of single-tenant industrial properties throughout the United States. Now, here's their real estate portfolio. We have 382 warehouse/distribution, 70 light manufacturing buildings, and 10% other. And by square footage, warehouses make up over 90%. And if we look at light manufacturing, it makes only around 8.6%, and other takes up the last bit at 0.8%. In terms of square footage, STAG has over 90 million square footage in industrial real estate. Now here are the top 10 tenants, with Amazon being number 1, and General Service Administrations at number 2, XPO Logistics Incorporated at number 3. But as you can tell with all these tenants, and if you look at the revenue, none of them make over 3% of STAG's revenue, which means that STAG's tenants are very diversified. So if something happens to one of these companies, STAG does not take as big a hit as some other industrial REITs. Now here's the top 10 industries STAG leases to. Auto components being their top 1, and air and freight logistics at number 2, commercial services and supplies at number 3, container and packaging at 4, household durables at 5, machinery at 6, building products at 7, food products at 8, internet and direct market retail, something to keep an eye on, is at 4.3%, and media is at 3.9%. There's not much recent news for STAG, besides the fact that they recently sold a property. STAG has diluted their stock a bit in order to pay off their debt and to help fund acquisitions. And STAG is now hosting rooftop solar panels, which is something to keep an eye on as well. Now here's STAG's most recent earning numbers summarized. 14.6 growth in revenue compared to Q3 2019, from 102 million to 117 million in Q3 2020. Net earnings per share increased from 7 cents to 15 cents. And in that earnings, there's a gain on sale of a building. So if we're just trying to look at their earnings per share from just pure rent, it's going to be lower than 15 cents. current ratio is 2.36. We have acquired 5 buildings in 2020 Q3, which is 629,681 square feet for 64.7 million. And STAG has sold 1 building, 425,300 square feet for a $9 million gain. Now, STAG has a rent collection rate of 98.2%, which is very good. Vacancy rate of 3.7%. It's better than the average at 5.7%. Rent change for the 9-month period at 7.4%, which is greater than the industry standard. And rent change for the 3-month period is 4.7%. Now here are the 3 biggest risks for me when it comes to STAG. We got dilution, interest rates, and overconstruction. Now, dilution. So dilution is a double-edged sword. The value of the shares decrease, but the proceeds from dilution can be used for expansion and paying off debt. So this is something to keep an eye on, but STAG has been diluting their stock for the past 10 years. Interest rates. So as an increase in interest rates could increase the amount of payments and the amount of debt payments that STAG is subject to, especially if the debt is on a variable interest rate. This could affect STAG's ability to make distributions to stockholders and expand as debt becomes more expensive. Now, overconstruction. In 2019, over 289 million square footage was added, and based on how rates were lowered, I'm guessing that there's going to be a greater amount of square footage built this year than 2019. And an increase of square footage lowers the pricing power of the industry, and quarter over quarter rent growth could slow because of this. Now here are some catalysts for growth for STAG. We got demand from e-commerce, acquisitions, and solar. So for demand from e-commerce, so because of how COVID has shut down a lot of shops, and people generally don't want to be avoiding people right now, a lot of people have started shopping online, and this has been a trend that has only increased to this day from previous years, as many people were, like before COVID, shopping online compared to just going to a mall. So JLL projects demand for an additional billion square footage based on the fact that e-commerce sales in 2023 are estimated to be over $6 trillion. And now here's STAG's acquisition. Overall, over 690,000 square footage was acquired in Q1, Q2, and Q3 of 2020 so far. So, as you can tell based on this graph, that STAG overall is growing in terms of square footage over time, which is a good thing for REITs, as they can use this additional square footage to rent it out and increase that revenue, and perhaps even increase that distribution. Also, STAG is now hosting solar. They're hosting over 25 megawatts of solar. Solar panels can be used to increase the margin by lowering the electricity bill for their properties, which is an interesting prospect. And they have been going hard on this recently, as I pointed out in the news that they have been doing this quite frequently, and I believe they're doing projects in Illinois and Maryland for their properties, installing solar panels on the top of their warehouses. So keep an eye on that, as there could be an opportunity in the solar REITs, or maybe STAG will dip into that. But in any case, at the minimum, solar panels can reduce the price of electricity for their properties. Now here's STAG's performance versus VU. As you can tell, STAG has been outperforming VU these past 10 years since its inception. At total annual return at around 16.52% versus VU's 13.77%. Now here's the dividends for STAG. Now dividends are important, as I believe dividends are one of the biggest ways to get return on this stock, as the current dividend is close to 5%. So STAG pays 12 cents per month. So for those who like monthly dividends, this stock may be for a year. The problem for this stock, though, is the average 5-year growth of that dividend is at 1%. Now the payout ratio, I'm not very concerned over it, as the way REITs are structured, you will always see a high payout ratio for REITs in general. Now here's my valuation on STAG based on the dividend discount H model. So we'll compare my fair value of STAG to its current price and the analyst consensus. So analysts are saying that STAG's fair value is at around $34, $33.89. Well, my fair value of STAG is at $32.40, and the current price is at $30.25. So if we're using my fair value, there's a 7.1% upside from its current price. Now let's do a holistic evaluation. So STAG is a growing REIT, as seen with its acquisition, and with a strong rent collection during COVID. This proves that STAG may be more resilient compared to its other counterparts, especially compared to commercial REITs like STORE or O. It's currently near its fair value, so there's not much upside. And if we apply a 5% degree of safety, I would put my buy target on STAG at around $28.74, or perhaps under $29. In any case, you should always do your own research before investing, and keep in mind the risk outlined I have presented or those you find during your own research. Now, in the comment section below, tell me what you think of STAG and what do you think of REITs in general, as I believe REITs in general are not overpriced compared to the greater market at this time. Anyway, have a good day.